Okay, so let me know if you can all see my screen. All good? Okay, awesome. Okay, so once again, thank you for joining us. So this is our corporate tax webinar, and I'm gonna quickly introduce myself for those of you that may not know who I am. And Varinda, who is also a team member here, she will also introduce herself. So both of us will be speaking today. So my name is Ken Green, one of the partners here at GMS Professional Corporation. This is a business we've been running since 2012 or 2013, and we are in business serving individuals and corporations, as well as we have a good practice for not-for-profit organization where we provide assurance services. I worked with PricewaterhouseCoopers a couple of years ago for about 4 or 5 years, worked in the banking sector for a number of years. And then in 2012, Celia and myself, we started this business. And so we've been doing accounting since, deriving a lot of joy just working with business owners, with the small not-for-profit clients we serve, and just with individuals, helping them plan better, fulfill their compliance obligations, and most importantly, to help them save on taxes. And that's one of the things we're going to be talking about today, how we can help you save on taxes. So I'm going to pass it on to Varinda. She can introduce herself quickly.
Good evening, everyone. Thank you again for joining us today for this webinar. My name is Varinder, and I'm a chartered accountant from India, where I was working in PwC as a tax associate. It's been nearly 3 years that I've got the privilege to work with GMS as a corporate tax lead, and where I assist my clients in providing end-to-end services, be it opening their HST account to setting their QuickBooks or filing their tax returns. Then I thrive to guide my clients through all the complex tax laws so that, in simple terms, so that they can focus on their business and leave the financial and tax obligation responsibility to us. This webinar is an extension of what we do. And as we go through the agenda, we'll let you know what all is going to be discussed in this webinar. So we'll go through the pros and cons of using a corporate structure for business. This will be quite an insight for people who are working as a sole proprietor and might be thinking if they should switch to a corporate structure or form a corporation or not. Then we'll talk about the legal and compliance requirement for a corporation, provincial and federal compliance obligations. These are pretty new, and we have seen people not complying to them and facing the consequences of the non-compliance. So we'll go through them as well. The best HST and payroll practices and compliance requirements, the newly introduced underused housing tax filing requirements, what's new for the 2023 corporate tax filing season, and then Ken will also walk you through general tax planning strategies for corporations and their owners, and many more insights on how to minimize the taxes and build tax-efficient wealth using a corporation.
Awesome. And so why is this webinar important for you? So most of you here have either indicated interest that you want to start a corporation, or some of you already have a corporation. And so one of the things we're going to be talking about today is to, bring some information to you so that you can see why using a corporate structure for your business will help you save a lot more in taxes. It provides you flexibility. And if you remember, our personal tax rates are quite high, right? So at the top marginal tax bracket rates, we have 53, almost 54%, compared to an average of about 12% on the corporate side. So there's a lot of benefits when you can move your business from a sole proprietor to a corporation. And so that's one of the things we're going to be sharing here today, and sort of give you some insights on how you can use corporation to plan. So this is just to give us a sense of the people in the room here today. So I asked 2 specific questions as part of the registration for this webinar. And the first one was, do you own a corporation? So majority of you say yes, that you own a corporation. So that's almost 52% of you that own a corporation. And a good number of you are considering starting one. So I'm assuming that some of you that are considering, maybe you own a business right now that you run as a sole proprietorship, or maybe you're thinking about going into business. And so I'm glad you're here. And so we're going to be talking about some of the reasons why, yes, it may make sense for you to consider using a corporation. And then the rest of you say, well, no, you're not interested. And maybe you want to hear us. You've not gotten enough from us and you want to come talk to us and hear what we have to offer. And maybe at the end of today, we may convince you why corporation may be a good idea to consider. The other question I had was for those that own a corporation. And so majority of you say, yes, I use an accountant to file my corporate taxes, so which is good. And then 29% say they've never filed their tax returns. And then the rest say they file tax returns themselves. So it's good for us to have this at the back of our mind to get a sense of people that are here today for this seminar. So Verinda will take over here.
Yeah.
Pros and cons of using.
All right. So as Ken said, for those who are still struggling to decide whether to open a corporation or not, so we are going to discuss the pros and cons of using a corporate structure. So the topmost pro for when having a corporation is that you have a limited liability protection. The business and the owners are two separate legal entities. And so in case your business or your corporation ends up in some legal suits or some legal issues, your personal liability won't get affected. It's only the business asset that can be sold to clear off those legal suits. So there's a big limited liability protection that you get once you operate as a corporation instead of being a sole proprietor. Second thing is transferability of ownership. Having a corporation and gives the flexibility to the shareholders to buy, sell, or transfer their ownership stakes without disrupting the ongoing operations of the business. You could be buying some shares of another corporation, or you could be selling some part of your business to someone else who is interested in buying or entering into a business without disrupting your ongoing business. So that's a great way of doing that by having a corporation, which won't be possible if you are a sole proprietor. And then the next things are, we have expanded deductions. You have small business deductions under corporate structures. We have various Canadian journalism tax credits and several credits under corporations which are not available to a personal tax in a personal tax return. Again, as Ken already mentioned, the corporate tax rates are much lower as compared to the personal tax rates. The personal tax rate which go as high as 50%, but the corporate tax rate will remain around 12 to 13%. Last but not the least is the LCGE, or the lifetime capital gain exemption, which can be claimed for selling the shares of a qualified small business company. If you already own a corporation and you're planning to sell your shares or part of your corporation via sale of share, you can always claim the lifetime capital gain exemption, which was set at the tone of 900,000 for the last year, that's 2023. So yeah, those are the pros for the corporate structure. Ken, would like to go to cons? You are on mute, Ken. Again, I think you're on mute. Can you? Okay. So yeah, so going on to the cons of the corporate structure, obviously having a new corporation or a new company will come with its own complexities and some extra administrative cost. There will be some filing requirements, maintaining corporate records and administrative tasks, and obviously having an accountant is gonna streamline most of these things. So it is a con, but it will definitely help you streamline your business. Then double taxation, any amount which is then taken out from the corporation as a dividend will get taxed again as dividend in the hands of the shareholders. But there's another catch that you will get a dividend tax credit when you file the income tax return as a personal tax return and report the dividend income. Last but not the least is compliance obligations. When you open a corporation, you will be required to comply with the Canadian corporation filing requirements and the reporting obligation imposed by the CRA, in addition to the personal taxes that you're already filing. So these are a few of the cons that you can take into consideration while taking a decision to either open a corporate structure or a corporation, or either continue as a sole proprietor.
Okay, and one other point I just wanted to add here that is a little bit more expensive if you have a corporation because the filing is slightly more expensive compared to filing personal taxes. So you have additional compliance obligations, you have additional costs, but again, all of these things can be offset by some of the benefits that you get with the corporate structure.
Most of those expenses will be deductible, right, Ken?
That's right. That's right.
Yeah. So now coming on to the legal and compliance requirements for the corporation. We'll be discussing about the important timelines for this tax season. As we are already into the tax season, we would just like our clients to be aware of the due dates for the payments as well as the filing due dates. As we all know, the corporate tax returns are due within 6 months from the end of the fiscal year. However, the tax payments are due within 3 months after the end of the tax year. So if your corporation has a December year end, your taxes or the corporate taxes should be paid off by the end of March, but however, you still have till June to file your corporate tax return. Going on to the HST return, if you are a monthly or quarterly filer, you're supposed to file the tax return within 1 month from the end of the reporting period. And similarly, the filing is also due within 1 month of the end of the reporting period. So, but however, for the annual filers, the payment is due within 3 months after the fiscal year end, and the filing is also due after the 3 months of the fiscal year end. So if you are a December year end and an annual filer, your HST return filing as well as the HST return payment will be due by March. If you are a quarterly, then 1 month after the end of that quarter or month, howsoever is the case. Then next is the T4 or T5 filing. T4 is for the employees, the remuneration paid during the year, and T5, the due date for the last day for filing was today to avoid any interest and penalties. And the remittances requirement for the payroll are required as per the CRA, set by CRA. It could be bi-weekly, monthly, as per your account. And the dividends and the taxes on dividends are payable when you file your personal tax return. They're not payable at the time of T5 filing, but they're payable in the hands of the person who gets the dividend, and they will be paying the taxes on that dividend income while filing the personal tax return before 30th of April. Now coming on to talk about some provincial and federal compliances which have come recently, and many of the clients are not aware of it, or many people are not filing these information return and have started facing the issue of getting the corporation dissolved by the federal government. The federal annual information return specifically applies to the companies which are federally registered, and they're required to file an annual return each year with the federal government. It's a pretty simple process. You just need to go on Corporations Canada website and click on filing an annual return. And the process is pretty simple. It doesn't require any number or number crunching or any financial information to be entered. It just requires basic information like last annual journal meeting information, confirming the business address, any changes to the corporation or directors. But this annual return is mandatory. It is due within 60 days from the end of the fiscal year, and if you miss 2 of them consecutively, your corporation will be dissolved by the federal government for non-compliance. And if that happens, obviously there are things we can do to revive your company, but still, let's not miss this filing and save ourselves from unnecessary administrative work. It's a pretty simple process. So if you are a federally incorporated corporation, we just request you to just reach out to us so that we can check the status of your corporation, if it's active, inactive, or if dissolved, if you haven't filed anything for the last 2 years, and then we can assist you to overcome the non-compliances. Similar to the federal filings, there's another prior to May 15, 2021, the annual returns for the Ontario corporations were filed along with the tax return, which all the accountants filed, the T2s. But after May 2021, the government introduced the Ontario Business Registry, and which allowed the businesses and non-for-profit to complete a wide range of transactions as well as file their annual information return within 6 months from the end of the tax year. Similar to the federal tax return, this also requires creating an account on the Ontario Business Registry. But for this, to start the process, you'll need to get a company key. in order to activate the Service Ontario account and access the entity profile. Once that is done, the process is pretty much simple, doesn't require any number crunching or a financial information input. It only requires the date of AGM or the details of directors and simple information like that. Again, GMS will be happy to help you guys if you have any return filing pending from last year or you're not able to navigate through the process. We'll be happy to help you. We also see many of our clients struggling with, or many people, corporate people, struggling with the HST or payroll, navigating through, because every month there's payroll remittance requirement, HST payments requirement, then there is filing requirements of HST, payroll, or T4 filings. So in order to just maintain or have a smooth transition or smooth working, you can always follow these best practices, which will definitely ensure that you never get charged any interest or penalties. First, for starting with HST, if your corporation's annual worldwide revenue exceeds 30,000, you must register for HST account with the CRA. This is as simple as just giving them a call that our services exceed 30,000 and we want to get registered for HST. If your services are exempt or not exempt, that can be looked after by checking with CRA if you are providing any exempt services. But if your services exceed 30,000, we encourage you to register for HST. The second step will be to collect the HST on the taxable goods and services provided to the customer at the appropriate rate for your province. The third step will be to claim the ITC. By claiming ITC, it won't mean just to claim the ITC on all the expenses. You should have detailed records of the HST paid on the business expenses, such as purchase of goods and services. This is the highest audited area by CRA. They will first come to check your ITC. So keep in mind to keep all the details record. So that's whenever an audit comes up, we are able to produce all the backup for the ITCs claimed in the HST return. Last and not the least is to file and remit the HST returns and collect the collected HST to the CRA as per the prescribed filing frequency. It could be monthly, quarterly, or annual, and just avoid all the interest and penalty charges. Now going on to the payroll, the first step will be to classify the workers that are working for you as employees or independent contractors. And based on the established criteria, we can help you identify if a person employed as a worker, employed as employee or independent contractor. Accordingly, a T4 for an employee or a T4A for an independent contractor will be issued at the year end. Then we have to be very sure that we are remitting the payroll remittances, which includes the CPP, EI, and the income tax to CRA timely to avoid any interest and penalties. We understand this could be a tedious process because payroll has to be done every bi-week or semi-monthly or monthly. So we usually help most of our clients set up a WagePoint account, which really streamlines all the process, because WagePoint helps you with giving monthly pay stubs, deducting the pay amount from the bank account of the corporation and depositing directly to the employee account, and as well as paying the remittances to the CRA timely. So with WagePoint, you can never get into the problem of getting charged with interest and penalties. So we always encourage our clients to get in touch with us and set up a WagePoint account for them and their employees so that you can always be compliant with all the payroll requirements. Now we'd like to talk about what's new for this tax season. There's some new developments that have been brought into our attention by the CRA. So we'd just like to quickly walk you through them. First one being the new trust filing requirements. Till last year, no trust or estate requirements were mandatory or required by CRA, but now, for the first time, for all the December 2023 year ends, any trust or an estate, they're required to file their trust returns by 2nd of April 2024. So we would encourage all our clients who have a trust or an estate to get in touch with us so that we can file the trust returns on time and avoid the penalties, which can range from $25 per day to $2,500.
And this is something that is new and can have some far-reaching implications. Particularly, we have a lot of clients that own, for example, they hold property. And so this may also apply to you if you are an individual holding something in trust for someone else, okay? So we have a lot of clients, either a corporation or them themselves, holding real estate in trust for their parents, for their friends, or for other partners, right? And so if you're in that situation, then this applies to you. Okay, so that's something that you have to just check and see if you're acting in trust in any of these relationships where you're either holding something or investing, you have a joint venture arrangement, then all of these things are new. Then you may fall under this category where you will have to file this tax return.
All right, there's some changes to mandatory electronic filing threshold as well. Beginning January 2024, if you are filing six or more than six information return, that's a T4 or T4A or a T5, you must file them electronically. We are already filing that electronic for all of our clients. So in case you're not doing that, this is just a heads up for all those clients who are not filing their information returns electronically. You might want to start doing that in order to avoid any penalties. Again, for the HST and GST reporting periods starting from 2024, all the GST HST registrants, with the exception of charities and selected listed financial institutions, they will be required to file their HST return electronically. We have already been doing this for all our clients, so in case you want to switch to electronic filing, please feel free to get in touch and we can guide you through. The next one is the reporting requirement for the Canadian dental care plan. This was something new, and since today is the last day for the T4, everyone would have reported that on their T4. You were supposed to, this is a new dental care plan which has been provided by the government, which will provide dental coverage for uninsured Canadians with an adjusted net income of less than $90,000. So all the employers were required to report whether they provide any dental coverage to their employees on the T4. If this was not done, it might result in financial penalties. So you might want to look into the T4 returns already filed to see that this was reported about the dental coverage part was reported on the T4. Yeah.
So another thing that is new is the underused housing tax. So this came into effect last year. So last year was the first time we filed it. But because last year was the first time, what happened last year was they extended the deadline to May, I believe. So we were able to file this for all of our clients. Now the deadline is April, all right? So the same deadline as personal tax returns. And so if you hold a property and that property is considered vacant and you own that property in the name of the corporation, then you have to file this tax return, okay? So if you own a property in a corporation, then you have the requirement to file. If that property is vacant, then you may be liable to pay this 1% tax penalty, okay? If you are a Canadian citizen or a permanent resident holding a property in your name, you're going to be considered an excluded owner. Okay. As I mentioned before, if you're a corporation holding a property in trust, then yes, you're going to be required to file. And if you're holding a property in partnership, if you have a joint venture arrangement, you'll also be required to file this tax return. So always good to pay attention to the filing deadline, April 30th, just because the penalties are quite significant, right? So 5,000 for individuals, 10,000 for corporations. There is also the CIBA extension. So most of you may have paid off your CIBA loans already. So if you recall, that deadline was December 31st, 2023, but the government extended it to January 18th. However, if you refinance through the bank, then you may have an extended deadline to sometime in March 28th. Okay. Now, for those of you that were not able to repay the loan, then you're not going to get that forgivable portion. So what that means is whenever you eventually repay the loan, you're going to get a deduction for that forgivable portion, because remember that forgivable portion would have been included in income in your tax return if it was done correctly in the year the loan was received. So if you don't qualify for the forgivable portion, just remember that you will qualify for a deduction for that amount when you eventually pay that loan back to the government. So now let's quickly talk about some corporate tax planning considerations. So as we talked about earlier, corporation is a good vehicle when you're running a business, and it will allow you save on taxes. So I just want to spend a couple of some time just to go through some ideas to consider in terms of how you use your corporation for tax planning. Now, the most important thing to remember is to remember that as a Canadian-controlled private corporation, you have this thing that we call small business deductions. Okay, so small business deduction is available to all Canadian-controlled private corporations, and right now the limit for that is $500,000. So what that means is up to $500,000 in taxable income, you get this deduction. And with this deduction, your tax rate comes down to about 12.2%. Okay, so this is the federal limit, is the same limit for most provinces, except for Saskatchewan that has a $600,000 limit. And this is one of the most common tax advantages that is available to Canadian corporations in Canada. Okay, so it reduces your corporate tax rates, and it allows you, because of that lower tax rate, it allows you to get this advantage of deferral, right? So where you can defer taxes just because you've left, for those of you that are leaving the money or the excess capital in the corporation. So right now, as it stands, that rate is just about 12.2%. And again, if you compare that to the personal tax rate, you see the gap. So personal tax rates is at the top marginal tax rate. We're looking at 54%, and here is 12%. So long as you leave that money within the corporation, you can defer all of those taxes until the point where you have to pull that money out from your corporation. Now, we do have this ability as a corporation to get the small business deductions. But there are certain things, there are certain rules, particularly passive investment income rules, that can limit access to these deductions. Okay, and so one of those rules is earning investment income. So if you earn investment income over $50,000, then you may get to a point where you start losing some of these benefits. The other one is capital. If you have taxable capital in excess of $10 million, you also start losing part of these benefits. So those are some of the things to consider, and for our clients that may be in a situation where they're breaking these rules or losing some of these benefits, will always bring it to your attention. And it becomes part of the planning consideration as well, so that you don't lose these benefits. One of the good things with corporation is the flexibility with planning your salaries, your wages, your remuneration in general. Okay, so with a corporation, you have this option to either take salaries or take dividends. If you take salaries, the salaries will become deductions for the corporation, but now that salaries go to your T4 and you have to report that in your personal tax return. Okay. You can also take income out as dividends. So dividend is not a deduction. Dividend is just the pool of capital that has already been taxed in the corporation that you're now pulling out of the corporation. So you don't get any additional deduction in the corporation, but now you have to pay taxes in your hands when you file your personal tax return. As Verinda mentioned earlier, you get a dividend tax credit to offset some of those taxes or all of those taxes paid in the corporation. And that's why we have this concept of integration. Okay, So there's this concept of integration, and the goal of integration is to get to a point where the tax situation is neutral, whether you're earning money in a corporation and taking dividends later, or just getting salary altogether. At the end of the day, the whole goal is to make it neutral. But that integration is not always perfect. Okay, so when we are discussing with our clients and planning, there are certain things to consider whether we do dividends or do salaries. Okay, so with dividends, one of the things to look out for with dividends is that you're deferring taxes, particularly if you don't need all that money right away. Remember, the income is taxed in the corporation at 12%. So if you don't pull it out right away, then all of that excess capital stays within your corporation, and you can invest that capital inside of your corporation. Okay, and so that way you get deferral of additional taxes if you don't take the dividends in that same year. Okay, you still get the deferral even if you take the dividends later in the future, maybe 2 years down the road, 3 years down, 5 years down the road, you still get that deferral, and that capital can grow while it is invested within the corporation. There's also the RRSP considerations, right? So if you want to contribute to RRSP, then it's important that you take salaries, because salaries is the basis for determining your room for RRSP contributions. Okay, so if we work with clients and we know they want to make or build some retirement savings using that RRSP vehicle, then we have to plan to give them some salaries, probably enough just to maximize their room, so that they can also contribute to their RRSPs. And again, so you can take the maximum salary to create the maximum room, contribute, and then that contribution again can offset some of those taxes when you file your personal tax returns. CPP is also a consideration, because with salaries, there is additional cost for CPP, right? So you as the employee, we have to contribute. The corporation will also have to contribute. So there is that additional cost. And if you max your CPP, you're looking at about $7,000 in total cost for CPP. But again, there's also a benefit, because now once you retire, you can tap into that pool of funds to supplement your income. There's also the child care expense deduction to consider as well, right? So if you incur child care expenses, then you need salaries for you to be able to deduct those expenses when you file your personal tax return, right? Because you can't just deduct those expenses with dividends. Okay, so you need to have all of those things, salaries to be able to deduct all of those things. So this is one of the reasons why we plan with our corporate business owners, because there are just different situations for different owners, and so it's important for us to consider all of these things as we have those discussions. Then we begin to plan, right? What to do, what not to do. At the end of the day, we want to get to an optimal position where we are maximizing deductions and minimizing taxes, not just for you alone, but for your entity together, your corporations, your kids, and your spouse. And if you have a family, we always encourage you to consider ways to get your family involved in the business. There was a lot of restrictions that the government introduced in 2018 with the tax on split income. But again, if you have families that are actually working in the business, you can also pay them reasonable salaries and have that as a deduction and use that as a way to income split within the business. Now, a lot of you have been feeling this pain with increases in interest rates. So the reason why I added this here is also to bring it to your attention, because as rates are going up, CRA is also increasing their rates. Okay. And so if you've been in a position where you're filing late, you're owing CRA taxes, then all of those costs will begin to go up for you. And so that's something to consider as you begin to to plan your taxes and manage your cash flow and your finances. So late filing penalties are now 5% for any amount, 5% on the amount owing, plus an additional 1% every month for that. Then there's a 7% interest on all tax debts that you're owing. And the crazy thing is that this interest is compounded daily, right? So it can be really, really significant if it's left unchecked. And the other thing to note is that this interest is not tax deductible, right? So this interest will have to be added back if you deducted it for financial statement purposes. When it comes to tax filing time, we have to add it back because it's not deductible for tax purposes. So it's always important to make sure that if you have requirements to pay installments, that you're paying them on time, you're calculating them properly, and these are things we can help you with. So CRA, they're not charging higher interest rates, so just be mindful of this as you plan. Then there are other complicated strategies to also consider. You can do corporate donations. So if you do corporate donations to registered charities, you can get up to 75%. You can get up to you can get a tax deduction up to 75% of your taxable income. And another thing to consider is the donation of public company shares. So let's say you invest within your corporation and you invest in public company shares, and those shares have grown significantly in value. You can donate those because now you'll be exempt from capital gains taxes when you make those donations to registered charities. And this can significantly bring your tax rate down to approximately 6%. And one other thing to consider is to maybe set up a private foundation, right? So if you get to a point where you have a lot of capital within your corporation, you can consider setting up a private foundation and then just move and donate a lot of those capital to your private foundation. And once you make that donation, because the private foundation is going to be a registered charity, you can get the deductions. And then now, because you control the private foundation, you can direct those funds the way you wish, right? So you can directly support the charities or the causes that are dear to you. And you can even sit on the board, get other people, friends to sit on the board, and then you can manage the affairs of the foundation and have much better control that way. Again, but remember, there are compliance requirements again that come with owning or managing a private foundation. So you have to file charity return, you have to do bookkeeping, you have to do all of these things. So while you get some advantages in terms of control, you also have to realize that there are other compliance burden that comes with that. There are other complex strategies as well. So you can choose to invest in tax-exempt life insurance policies. So all of these policies have some good advantages. The good thing by doing it with corporate capital instead of personally is that, remember, you're only paying taxes in your corporation at 12%, right? So all of those tax dollars that you're not going to be using to invest in these policies have been favorably taxed, right? So just to give you an example, if I have to buy an insurance policy in my personal name, the advantages will be, the benefits are going to be similar, right? So whether it's in the corporation or in my name, the benefits are similar. But now for me to pay, let's say I want to pay a $1,000 premium every month, okay, to buy an insurance policy, then I have to earn a lot more to be able to have $1,000 to buy, to pay for that premium, because my personal tax rates are much higher. But in a corporation, I don't have to earn that much simply because the corporate tax rate is much lower. Okay, so that's why the corporation will be in a better place to come up with that capital to invest in insurance policies. So one thing to note is that the premiums are not tax deductible. And the reason for that is because the proceeds from the insurance policy are not taxable. right? So those proceeds are not taxable, and so that's why the premium is not tax deductible. But the good thing is that the investment income will not be included in income in your corporation. Okay. And so earlier I talked about some of the things that may make you lose your status as a small, or make you lose some of the small business deductions. And one of those is investment income. But if you have this investment in a tax exempt life insurance policy, those income will not be included in investment income in your corporation. And those income are also going to be deferred within the policy. And you can also use these policies as ways to plan for income, to plan for retirement. So there are lots of strategies that you can employ when it comes to using a corporate policy as a tool for tax planning. You can also set up what we call the individual pension plan. So this is the IPP, right? So IPP is a very attractive retirement savings option, which you can use instead of using your RRSP. So if you have an IPP setup, contributions to that plan is tax deductible. The investment inside the plan will also grow in a tax deferred basis, just like an RRSP. With the IPP, you can get more contributions compared to an RRSP. Okay, so with RRSP, we have that contribution limit that is calculated based on your income. But again, with the IPP, those limits are slightly higher compared to the RRSP. And then the final point there is that if you make poor investment decisions, then there's an ability to make up for that, right, with the IPP. So that's something that is not available with the RRSPs. Okay, so these are just few planning considerations to consider as you use corporation. So there are lots and lots of other benefits when you work and use corporation, particularly if you run a lifestyle business. Okay, so if you run a lifestyle business, then there's just a lot and lot of opportunities where you can convert regular expenses that you pay with after-tax dollars. You can now convert those to before tax expenses, just because you run a lifestyle business that can allow you to do many things. So these are just some benefits. Obviously, if you have a corporation, you talk to us, we can always have a chat to tell you some other things that you can benefit from. So we can certainly support you. We have services for corporate taxes. And so these are the options that we have if you own a corporation. So you can choose one of these options and we can help you provide services for your corporation. And here I've provided some links to some of the services that we offer. Corporate tax services, if you go to our website. We also provide bookkeeping services. And I talked about the underused housing tax. And so if you go to that link there, you'll see the service options that we have to help you file your UHT return. And those options are there. You can either do it yourself. We'll provide some training on how you can do it yourself. And if you want us to do it for you, we can also do that for you. Again, this is our contact information, office in Mississauga, phone number, website information. And if you need to reach me directly, that's my email address. If you need to reach Verinda directly, that's her email address there. And this is the rest of our team. So we have a team that provide a bunch of other services. So we do audits, we help with bookkeeping services for corporation. We obviously help with your personal tax returns. And so if there's any need out there that you need to meet, just let us know. We can provide those services to you. All right, so we're going to open it up now for questions. So if you have questions, we'll be happy to answer those questions for you. So you can either drop it in the chat or you can unmute yourself and just ask your questions. if there are any. I know we went through a ton of information here today, but let us know. Okay, so if there are no questions, then I think we can end the webinar. Well, if anything comes to mind later, just feel free to reach out to us. You have all our contact information. So what I'll do later is to send the slides and send the recording for this webinar to all of you, and to register for this webinar. And then if you have any questions, just let us know. So I just want to thank you for making the time to be here today. Hold on, I think I see something in the chat. So I see a question here. So the question says, what are the lifestyle expenses? So what are the lifestyle expenses one can write off in a business? So I can answer that. So in general, if you want to write off expenses in your business, in general, you can only write off expenses that are directly related to your business. Okay. So I can give you an example. So for example, I invest in real estate. Okay. I invest in real estate. I use my corporation for my real estate investments. So let's say, for example, I love to travel to US or to Belize or to anywhere. Or maybe I like to go to Calgary. So I have a property in Edmonton, for example. And let's say I want to go to Edmonton. Because I have a business that owns a property in Edmonton, I can travel to Edmonton, do my business, spend some time to do my vacation, come back home, and majority of those expenses I can deduct for my business because most of my trip was business related. Okay. If I love going to Florida, for example, I can go to Florida and buy an investment property in Florida. And so now my trip to Florida becomes a business trip for the most part, right? If I'm there on business. Okay, so these are some of the ideas when I talk about lifestyle business. Okay, if you love to travel, let's say you love to travel, why can't you start a travel business? Right, so we have clients that run travel agencies, travel business. You love to travel, you start a travel business. And then now, all your travel, as you're promoting your business, you're also enjoying the different destinations you're going to. And then you're running a business, and most of those expenses will become deductible expenses. Okay, so that's essentially what I mean. And those are some examples. And these things you can apply in many ways. But the most important thing to remember is that if you're running a business, the expenses have to be directly related to that business. Okay, for you to be able to deduct those expenses. All right, so hopefully I answered your questions. Let me know. If not, you can unmute yourself and we can chat. Okay, so Varinda, do you have any closing comments? Then we can wrap it up.
No, I just thank you for your great insights and those great tips, and thank everyone else for joining us this evening.
Okay, all right, so thank you all for coming. And if you have any questions, you can always reach out to us. Okay, all right, take care, guys.
Good evening, guys.
All right, bye.